Hello, everybody, and thanks for joining me here at the Pilot Money Podcast, coming at you from the national headquarters of Aviation Retirement Strategies here at the George Bush Intercontinental Airport. My name is Alex Tapia. I'm the president and the founder of the company. And today I want to talk about Silicon Valley Bank and everything that you've been hearing on the news since last Friday when Silicon Valley Bank actually collapsed due to a run on its bank. And then a couple of days later, yesterday, Sunday, another bank, similar bank, collapsed, which is called Signature Bank. And I want to talk about, what that actually means. And, because I feel like a lot of people don't necessarily understand the relationships of banks and investors and how they make their money, how they pay their money, and all those kinds of things. But more importantly, I want to talk about how this affects you as an individual investor and also how it affects your portfolio, if it does at all, and how are we positioning ourselves to protect you as our client from a negative potential fallout from something like this. So let's go ahead and get started. I think it's important to understand that this was not what you would think is a typical run at a bank where you have individual depositors basically lined up around, and at least this is what I would, the first thing that comes to my mind, where they're lined up around the side of the bank, needing to take their money out because they're afraid that they're going to lose their money. It wasn't really quite like that because Silicon Valley Bank, by nature and by its location, was a big partner of this big tech companies that reside in the Silicon Valley, and it was a big partner in helping them with investment banking and providing loans to those companies. And so there was a lot of big transactions, and there was one particular company that was looking for their money, and Silicon Valley Bank had a hard time coming up with the funds in order to give the depositor their money back. And then once the word got out, the other corporations basically started doing the same thing, demanding their money back. And the Silicon Valley Bank did not have the funds in order to be able to give it to them. And eventually, by the afternoon, that caused the collapse of that bank, and eventually, a couple days later, Signature Bank as well. And so it's an important distinction that these were not individual investors going after their money. In fact, most individual investors would probably not have had too much trouble because most of their money would have been insured up to the FDIC $250,000 limit. So it's an important distinction to make, I think, before we go on with the conversation. But more importantly, why was it that Silicon Valley Bank did not have the funds in order to be able to pay their depositors back when they needed the money? Well, it all has to do with bond prices and interest rates. So, what a bank does initially when somebody deposits money into their bank, what they do is in order to be able to provide in a certain amount of interest rate that they promise and to be able to monetize that deposit for themselves, what they do is they go to the federal government, they buy U.S. Treasuries. And U.S. Treasuries, by nature, they're just basically a bond. It provides, it's a bond that they have to buy, and it provides a certain amount of money in return so that they can, like I said, monetize the initial deposit. Well, bond bonds, as they're tradable instruments in an open market, and they're unbeknownst to most people, bond prices actually fluctuate on a daily basis. A lot of people think that the bonds are pretty stable, which they are compared to U.S. equity or equities in general, but their price does fluctuate on a daily basis, and the fluctuation primarily depends on the interest rates that are currently in effect. So, as you know, the U.S. government has been raising interest rates for quite a while now by either 0.5% or 0.75%, whatever they've been doing. And so over quite a long period of time, they've raised interest rates significantly. Well, the price of a bond is directly and inversely related to interest rates. So when interest rates are really, really low, bond prices are very, very high. Or when interest rates are really, really high, bond prices are very, very low. Well, when um, when interest rates were extremely low, like near zero, like they've been artificially have been manipulated for years now, when somebody deposited money, these banks were buying these bonds to be able to monetize these deposits. They were buying these bonds at the highest price that they've probably been in for decades, actually, and which was fine so long as they kept interest rates as low as they had. But when they started raising interest rates, the prices at which these bonds were bought started going down significantly. And now, because interest rates have gone up quite dramatically and quite fast, when a depositor comes back and asks for their money, the bank has to sell that bond at a much, much lower price than it originally had bought it for, giving them a significant loss on that investment. Now, that may work out for one depositor, and may be okay to take that loss, but multiple deposit, maybe hundreds of depositors, they come in and they start demanding their money back. The bank has to be able to give it to them, so they have to sell those bonds at significant losses, which eventually, if you do that for enough volume, will eventually create your collapse, which is exactly what happened to Silicon Valley Bank. So how does this affect us directly? Well, if you look at your portfolio, most of our portfolios, unless there's a very, very specific reason as to why they would not be, they are extremely well diversified, and we're all over the place. We invest primarily, at least right now, although that's slowly changing for us here as we strategize in a different way going forward based on what's going on. But most of our portfolios today are invested in exchange traded funds, which are extremely well diversified portfolios, and we actually have very, very little exposure. In fact, I can't think of one. I'm sure there is somewhere in there, but we have very, very little exposure to specific banks and financial institutions like the Silicon Valley Bank. So our portfolios really weren't that affected. And if you notice, even today after market close, your portfolio really didn't do anything out of the ordinary. Because we're just not exposed to that sector. Although there's a lot of financial companies, banks that didn't trade very well today for obvious reasons. We are just not part of that equation, and that was also by design. So we're just not that concerned overall of what this is happening, unless something goes awry and something happens that we're not expecting. Also, one of the good things that may come out of this, and we're not really sure if this is going to happen, but it's certainly possible that the Fed will start slowing down interest rate hikes because of this problem, because it wants to avoid future banks collapsing in the same way. It may start slowing down its interest rate hikes, which will greatly help the economy, especially the tech sector, where all those large growth stocks that were just battered last year because of high interest rates. And once the Fed starts slowing down, that part of the market will start coming back, and that's a bigger chunk of our portfolios. It's not the biggest chunk, but it's a significant part of really any portfolio, as it should be. But they were just really clobbered last year. So, by slowing down interest rates, that might help revive that sector, which has actually been kind of on a comeback here since really the beginning of the year. So that is also a good thing, and we're not really that concerned about the overall markets. Because we're not exposed to it, and hopefully, if they do interest rate, they slower the raise of interest rates, it may actually be a positive for us as well. Now, one great question that we had earlier this morning from somebody that called in is, what do we do with our cash? I mean, do we use the banking system? How do we deal with that part of it? So, well, there's really two ways in which we deal with cash. One, which was pretty favorable for us, which is slowly in fact, we've completely transitioned out of it, and that's what we call an insured cash account, or called an ICA. And basically, what an ICA does is take somebody whose deposit maybe had, usually with our clients, we have usually more than $250,000 available to us, and sometimes that goes to cash. And when it goes to cash, we put it into the insured cash account, which basically what it does, it spreads these assets. Let's say that you have $500,000, and we need to put it in cash for some reason. The ICA, the insured cash account, will spread that money over at least two banks, so that never are we over the insured limit of $250,000, to make sure that we have all the money protected in case something happens to a bank. So there's an internal protection in there that we've been using. All along. You may or may not have known about it, but that's basically what's been happening with the cash. We're always make sure that if we use banks, that they're always insured. Also, these days, because of interest rates, we slowly started transitioning to money markets, and specifically basically a money market fund that we're using that right now is paying somewhere around 4.4% or something like that. It changes on a daily basis, but it's around there. They are not necessarily insured by the Federal Deposit Insurance or FDIC, uh, but they're also not exposed to the banking sector because they are bonds. It's not like we're putting the deposits into a banking system, which and then buys the bond. We are literally buying a fund that provides us cash, so they're not necessarily insured, but we're also not exposed to that problem with the money that we have there. And that's really the place of choice for now, where we have been putting money in. So we're just not really exposed to any of these problems in any capacity, really. So which is really good news, and I hope that makes you feel a little bit better, because when you listen to the news, it's very dramatic and it's very sensational, and I get that it makes people nervous, but I hope that this has kind of cleared things up. You are not necessarily, in fact, very very little, if any, exposed to this problem that we're having today. We're hoping that the Fed might slow down interest rates will eventually help your portfolio as well. But any money that we do have that we call cash is not part of the banking system, and it's actually getting a very, very good interest rate. And there's no real chance of that collapsing like the Silicon Valley Bank, or there's not going to be a run on this money in any way. So we're pretty comfortable and confident about that. So I hope that kind of explained things a little bit. I try to keep it as layman terms and as short as possible. But if you have any questions, please feel free to reach out. We're always available to answer your questions, and obviously also always working to do the best thing that we can with the investments that you've entrusted to us. But we appreciate you taking the time to listen. Once again, my name is Alex Tapia with the Pilot Money Podcast, taking care of the business end of your aviation career. We appreciate your time, and we'll be talking to you soon. Thanks so much.